Good evening. Welcome to the weekly market wrap up. The Sensex and Nifty ended the week on a negative note by each shedding 0.2%. On a year to date basis, however, Nifty and Sensex are up 4%, while the mid cap is up 2%. The small cap continues to underperform its large cap peers and is down 6% on a year to date basis. Coming to a sectoral performance, banking sector, energy sector, and FMCG sector continue to witness strong investor interest on the back of tailwinds in the sectors. Banking sector, however, has seen the highest amount of interest from retail investors, especially the PSU banks, on the back of a rise in the asset quality of these banks after a period of almost 3 to 4 years. Auto sector continues to be an outperformer, being up 17% on a year-to-date basis. IT sector, however, has witnessed a great correction to a point of about 24% on the back of weak macroeconomic and geopolitical risks. Concentrating on the auto sector, good markets, good market sentiment coupled with festive boosts resulted in higher sales in October, especially for the passenger vehicle segment, which grew 29% on a year-on-year basis. Higher inflation and rising interest rates have impacted the rural market more, thereby returning very marginal growth in the two-wheeler segment. The passenger three-wheelers, however, are seeing a better offtake in the semi-urban and the urban areas due to increased share mobility. The sale of PVs was also supported by easing of supply constraints and which helped the automakers to ramp up their supplies and fulfill the backlog of their orders. Overall, the sales of automobiles across categories rose around 6.2% in the month of October. On the commercial vehicle side, LCV continues to witness strong demand and it rose around 23% on the back of great demand from the e-commerce and the last mile delivery segment. The MHCV segment, however, is witnessing a strong growth, albeit on a low base, mainly due to a replacement cycle kicking in and easy financing available for these MHCV suppliers. In my opinion, passenger vehicle will see a continued sustained demand on the back of rising discretionary income, while the CV segment will see a increase in demand on the back of increase in manufacturing capacity and productivity of the industries. Secondly, concentrating on the auto ancillary side. Domestic OEM demand constitutes around 50% sale for the Indian auto component industry. This is also likely to be healthy in FY23 with double digit growth expected in both PV and commercial vehicle segments as we discussed before. ICRA forecasts a revenue growth of auto ancillaries to be in the range of around 8 to 10% in FY23, mainly led by stable demand and likely easing of supply chain concerns in the second half of FY23. The agency also expects the sector's coverage metrics to remain comfortable in this fiscal, benefiting first from healthy accruals and secondly from relatively low incremental debt funding requirements for these companies. The export orders, however, have seen a slowdown in the last few months, mainly impacted by inflationary pressures, geopolitical tensions, and supply chain issues. In FY22, auto component companies with cumulative revenue of over 1,75,000 crores had registered 23% year-on-year growth in revenues, mainly driven by domestic OEM, replacement, export volume, and pass-through of commodity prices. Though the growth came on a relatively slow base of 21, the actual revenue expansion was partly on the account of better than expected exports and increase in realizations to pass on the impact of higher commodity inflation and freight costs. However, in the current scenario, the unprecedented inflation in raw material and freight costs in the second half of FY22 and inability to pass on the same in the timely manner impacted the profit margins last year and also spilled over in the first half of FY23. Operating margins for these auto and companies were at their lowest in the last 5 years. Coming to the capex spend of these auto ancillary companies, we are definitely seeing an increase in capex spending by auto ancillary companies, mainly towards setting up of capacities. Uh, In FY22, the capex spending was at its lowest, uh, at around 6% of the net operating income for auto component companies, uh, in comparison to a pre-COVID average of around 7.5%. The incremental investment that we are seeing in capex is towards new product additions and development, especially of EV components, unlike investments which were seen before into just capacity expansion, which has been a trend for the auto companies in the past. Going forward, the recently announced PLI scheme will contribute to accelerating capex over a medium and a long term, besides investment by new entrants which have been happening in the EV segment. In the end, be it the PLI scheme that boosts manufacturing, or the encouragement for EV vehicles and hybrid vehicles, or ethanol blended petrol, the government has taken many initiatives to empower the automobile industry. We see the auto upcycle going forward for the next 2 years on the back of sustained growth in the economy and growth in the income of the country. We continue to remain positive on the entire auto space and would prefer to play the auto space not through the OEMs but through the auto ancillary players who have significant market share in the industry. That's it from my side. Thank you and have a nice weekend.